Hello, everyone, and welcome to a fresh new episode of our Made for YouTube series. I'm Sumaira Abidi, and today we're going to be talking about a set of funds from the fixed income side called the floater funds or the floating rate funds. Now, essentially, they would be funds which invest in bonds which have a very peculiar characteristic, and which is that the interest rate or the coupon rate fluctuates or moves or changes or floats, and which is why the name floater fund. But that is just the definition. Let's try and understand what these type of funds are really all about. What are the intricacies, the advantages, disadvantages, and what kind of investors they're suited for. So let me invite Mr. R Sivakumar, who's the head of fixed income at Axis AMC. Hi, Siva.
Hi,
Thanks
Sumaira.
very much for joining in yet again. So let's start by talking about what exactly are floater funds, and what's the kind of need that they service.
Yeah, thanks for having me on, first of all. And I think you introduced this quite well, that to say that floating rate instruments are instruments where the coupon rate changes over time and typically linked to a benchmark, which is to say that in a period of rising interest rates, the interest rate on these instruments rises. And when interest rates go down, the interest rates on these instruments typically falls. The reason this is important is because, unlike regular bonds, which pay a fixed rate of interest, here the interest rate on these instruments varies over time and varies with the interest rates in the economy. As we know that in the case of fixed rate bonds, there's an element of what's called interest rate risk, that an inverse relationship between interest rates and the price of the bond. As interest rates rise, the prices of the bonds fall. This is because let's say, for example, you contracted a lower rate of interest in the past and now interest rates have gone up. The lower interest rates are now less valuable as compared to before. But imagine if you have a floating rate instrument where the interest rate goes up as interest rates in the economy goes up, and what happens essentially is that the rising interest rates are neutralized by the rising yields on bonds. So effectively, floating rate instruments are a very different class of instruments where the interest rate risk is very different from other bonds.
So, Siva, what is the need that they service in a portfolio? I mean, if I, as an investor, already have, say, a debt portfolio, for what requirement would I need to invest in a floater fund?
Yeah, so typically this, as I mentioned, has the opposite reaction to interest rates as compared to a normal bond fund. A normal bond fund will benefit in a falling interest rate scenario because of the same inverse relationship. In a falling interest rate scenario, the existing bonds in your portfolio become more valuable, and therefore those funds tend to outperform. But in a rising interest rate scenario, the opposite happens. A floating rate fund typically benefits because there the interest rates go up or the returns go up when the interest rates in the economy go up. So the question is where in this economic cycle we are. And if we believe that we are about to embark onto a rate hike cycle, then floating rate funds will start to outperform. So therefore, one reason for owning floating rate funds is if you believe that interest rates are about to start rising. That, for example, that the RBI will start increasing interest rates in the future as we come out of this pandemic and go into a growth strategy. That's one part of it. The second part of it actually is a hedge, because you may already have a lot of fixed rate bonds in your portfolio or a fixed rate funds in your portfolio. And you may take a view that if I want to hold long enough, let's say if I have a view of 5 years, 10 years or longer, there will always be periods of rising and falling interest rates in that cycle. And therefore, I would want to have a certain allocation in a different type of instrument within the fixed income space. So for these two reasons, we believe that one is a little bit strategic reason, that's the allocation type of a reason, and the other is based on a market view, that we believe that interest rates are going up, and therefore you may need to introduce some floating rate in your portfolio.
Okay, so rather than disturb the existing portfolio, you add on a floater fund to sort of take the benefit in a rising interest rate cycle. Am I right? And also, is this the time, therefore, to be investing in a product like this?
Yeah, so to answer the first part of your question, see, mutual funds, including in open-ended funds, for example, fund managers can and do invest in floating rate instruments in across various portfolios. So fund managers themselves may be adjusting their portfolio duration by buying more floating rate instruments if they anticipate a rising interest rate cycle. But there is a limit in which to which you can do this because of the requirements of their portfolios. For example, most of the portfolios have strict norms in terms of the duration that they can run. So the duration cannot be reduced beyond or below a certain level, and therefore if you want to further reduce it, if an investor wants to further reduce it, the only way is to either purchase a fund which is of lower duration or buy a floating rate fund. So they here what we are trying to say is that now we do believe that we are about to embark into a rising interest rate cycle. Therefore, it does make sense for investors to look at floating rate instruments.
Okay.
Now, coming to that part of the question is, do we really believe that interest rates are going up? Yes, I think there is a very good chance that in the next 2 years we will see RBI significantly raise interest rates, and so we must be prepared for that. And it doesn't really help if you act after the fact. You might want to sort of build your portfolio upfront rather than wait for the events.
Okay, so if there is somebody who has made fresh investments in the last 1 year, they could rotate them in favor of a floater rate fund. Would that be the way to see things?
Surely, I think it's important also what category of funds you're invested in. So, if you are invested in very long duration funds, I would certainly urge a relook at that, because certainly in a period of rising interest rates, longer duration bonds typically tend to underperform. But if you're already invested in money market type instruments or low duration funds, ultra short term funds, etc., then you may not need to change your portfolio all too much. Because we have to remember that, let's say, for example, in the case of an ultra short duration fund, which typically maintains duration between 3 to 6 months, what happens is that the fund is automatically repricing. The existing bonds are maturing, and typically within a 3 to 6 months time frame, and most of the portfolio is getting rolled over. This, in effect, behaves like a floating rate instrument, because in a rising interest rate scenario, the yield on the portfolio keeps increasing. So there is an automatic rebalancing which happens in very short duration portfolios such as money market, low duration, and ultra short portfolios. But other longer duration funds, certainly, you should evaluate whether you want to have at least a part of the portfolio in floating rate.
But are there different types of floater funds, or is there just the one?
No, there are a lot of different strategies within floating rate funds. It also comes down to the fact that the floating rate market in India is not very large. So one of the biggest issuers of floating rate bonds is the government itself, which has recently started a program of issuing floating rate bonds. And there are a few other issuers who issue floating rate securities. But broadly, what happens is we use a concept called synthetic floating rate instruments, wherein the fund manager buys a fixed rate bond and then uses a derivative, much like what you do in an arbitrage fund by buying a stock and shorting a future. The derivative essentially has a negative duration position. So the duration gets kind of neutralized, and therefore you have a synthetic floating rate option. So the swap, it's called, what's called the derivative is called a swap, and it swaps a fixed rate for a floating rate coupon. This strategy has certain open aspects. So, for example, you could have a mismatch between the swap duration and the bond duration. So that introduces an element of residual duration in your portfolio. So what happens is that even though there are floating rate funds, they do have a range of duration. Duration in floating rate funds comes from three sources. One is this mismatch between the swap duration and the bond duration. The second is, to give you an example, Government of India issues floating rate bonds based on 6-month T-bill rates, and it gets reset every 6 months. But during those 6 months, when you are not getting a reset, you are running 6 months of duration. So there is even though it's a floating rate instrument, it does have a residual duration, and corporate bonds can have floating rates anywhere ranging from let's say 3 months to 12 months. So there is a residual duration element there. Lastly, 100% of the portfolio is not invested in floating rate instruments. The regulatory requirement is for 65% to 100% in floating rate instruments. So consequently, up to 35% can be in normal fixed rate. All of these contribute to the duration of the fund, which means that even though they are floating rate instruments, they are not immune from disruptions in a rising interest rate environment. So even when you are investing in a floating rate fund, it makes sense to look carefully at the duration of the portfolio. Because if the objective is to protect against the rising interest rate environment, it doesn't make sense to buy a floater fund which has a very long duration. So I think it's very important that investors pay close attention to the fact sheet of the portfolio to make sure that you're buying a floating rate fund which has a relatively short duration.
Okay. So is this aspect of duration risk its only limitation?
See, that's the critical factor here. Now, of course, that is a critical factor in a rising interest rate scenario. Obviously, floating rate funds, the biggest risk is that interest rates start going down. right? As I mentioned, that floating rate funds or floating rate instruments benefit from a rising interest rate scenario because the coupons go up. What happens when interest rates start to go down is that coupons start going down. So then the expected return or the outcome is lower than what was initially expected. So floating rate instruments, the first key risk is of course the risk that interest rates go down. But today we are not anticipating that. We are actually anticipating that interest rates go up over the next couple of years. So therefore, if you have a rising interest rate scenario, then what matters is the residual duration of the portfolio. So do be mindful of both aspects. First, like I said, the market view, which needs to be aligned with the fund. That you should buy a floating rate fund only if you expect interest rates to go up. And within that, if you do expect interest rates to go up, then make sure that you're buying a fund which has moderate duration risk.
But Siva, for years we have been actively discouraging retail investors from trying to play this interest rate cycle. Then isn't it sort of counterproductive to say that if you have a view that rates are going to go up, there is a product that might benefit from it? I mean, why not just keep a debt portfolio going according to the goal you might have aligned it to?
And I completely sympathize with that point. And I think that's absolutely the right strategy for investors, which is that do not try to add too many strategies or do not try to time them out. So at the core of it, if you do know what your investment horizon is, then aligning your duration of your portfolio with your tenor of holding is a usual sort of rule of thumb. So for example, if you have a view of, let's say, holding for the next 5 years, then any fund which typically has a 5 year or lower duration is typically considered acceptable risk for that investment horizon. Okay? That makes absolute sense to me. So do not disturb your position if you are investing on the basis of some simple working rules of thumb. But if you here the floating rate instruments are in that sense a specialized class of funds. So this uh, category has been created by the regulator to specifically address the needs of those investors who have taken the call to invest in floating rate securities, so as to give a separate category. So it is not necessary that every investor must look at floating rate funds separately. So that's the first part. The second is, as I mentioned before, fund managers do buy floating rate instruments in their existing portfolios. So or use swaps to reduce duration in their existing. So if we do that actively, that reduces the need for investors to have an explicit floating rate fund. So I'm not saying that floating rate funds are needed by all investors, but investors who are choosing to invest basis on a market view because they expect rates to go up, certainly it makes sense.
Yeah. So basically, just because a product is there, don't dive into it head first. See the kind of investor you are, and whether or not it makes sense for you. Okay, if somebody was to take this sort of tactical positioning and look at a floater fund, how do they distinguish between the many schemes that are there? Are there, because every fund manager, I'm assuming, with I mean, it's like being first amongst equals, right? So everybody would have a similar call that rates are going to rise. Is there much differentiation between different schemes?
There is, and as in the case of normal funds, this comes down to the same two critical factors. One is what is the duration and what is the credit profile. And in the case of floating rate funds, even though the instruments are floating rate in nature, like I said, they do have residual duration risk. So the first risk you need to look at is what is the duration risk of the portfolio. And every fund manager would, or every fund house would have a different style in their floating rate funds as to how much duration risk they are willing to put on. The second is credit risk. There are floating rate funds which range all the way from 100% AAA to kind of mixed and some having a fairly higher allocation to non-AAA bonds. But again, that needs to be aligned with the kind of risk that we want to run as investors. If the fund allocation, for example, let's say it allocates 80 or 90 or 100% in AAA, if that fits with our style, then that fits the investment. So I think these two, the duration and the credit risk, need to be kept in mind when choosing a floating rate fund. And that is the same rule. These two parameters are much the same that you need to keep in mind when you're making an investment in any fixed income fund.
Okay, but essentially these would be for high risk investors, right?
I think not. I think the beauty of floating rate funds is that it's in some sense they are kind of a fillet shuttered bucket product because If you invest long enough, so let's say if you're investing for the next 5 years, 10 years, etc., then you will get about the average interest rate in the economy over the next 5 years or 10 years. Because you will see interest rates go up and down over time, and while the floating rate fund returns also will go up and down in tune with it. So in the long run, the returns will equalize. Whereas if you buy a long duration bond, you may get similar outcome in the long run, but your journey may be different because periods of rising interest rates, the fund will underperform and vice versa. But I think I'm not sure that there's going to be a significant difference in performance for long enough term investors, but the journey would be somewhat different, and therefore for many investors it just acts as a counterbalance to certain other parts of the debt portfolio. So there's a good reason to have a certain allocation. This kind of acts like another version of a cash management or a low duration type of a portfolio. And I mean low duration not in terms of the category that SEBI has defined, but rather anything which is let's say below 1 year or 2 years duration. So that part of the portfolio allocation, there's a good reason to have that in floating rate instruments, because that gives you a more smoother ride as compared to a normal bond.
Okay, I have a very quick question for you, Shiva. Because you chose the example of arbitrage to explain, the working of a swap. Why not an arbitrage fund? I mean, that will also give you. I mean, it's a low risk investment as well. Plus, you get what 4-5%. Maybe a little bit more. Why not an arbitrage fund over, say, something like a floating rate fund?
Yeah, and I think for many investors that will be an important consideration. Obviously, tax treatment of arbitrage funds also tends to be slightly better for shorter duration investments compared to a floating rate fund or any other short duration fixed income security. So in that sense, I think arbitrage funds should be in everybody's consideration set to start with. But remember that arbitrage fund yields are determined by two factors. One is the interest rates in the money market in the very, very short end. We're talking about 1 month to 3 month space, and the kind of bullishness in equity markets in some sense. The more leverage there is in equities, the better the returns are on arbitrage. So because at the end of the day, the arbitrage funds play on the spread between the cash and the futures. These two factors matter a lot when it comes to arbitrage returns. So the drivers of arbitrage returns are very different from floating rate drivers. So at one level, they are similar because both of them do have short-term money market rates as a basis. But arbitrage gives you a slightly different flavor in terms of it also introduces the sort of bullishness in equities or leverage in equities as one extra kicker from time to time. Obviously, when equity markets are very bullish, you do get high yields, but when equity markets are not so bullish, arbitrage funds tend to underperform other fixed income instruments. So keep that in mind. It gives you a different flavor, and it does not replace floating rate funds or liquid funds or any other fixed income security.
Understood. Siva, always a pleasure hearing you. Thank you very much for once again tackling a subject which sometimes can be tricky to explain, but doing it in a very, very simple and effective manner. Thanks very much for joining in.
Thank you, Sumaira, and have a nice day.
You. All right, and thanks to everyone for watching this. I hope it's been beneficial for you. If you have any questions and comments, we look forward to hearing from you. And do stay safe. And we'll be back with next week with another fresh episode. Thanks for watching.